In this week's video, we'll review some hard evidence that says stocks could throw investors some significant curveballs over the next 15 years. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. If you're experienced in the markets and with technical analysis, bear with me. We'll take some simple concepts, then we'll look at history, and then we'll tie history into the present day from a probabilistic perspective. If you want to read all this, you can pause your video player in the lower left-hand corner. Purpose here: consolidation is basically indecisiveness. The bulls don't have enough conviction to break out. The bears don't have enough conviction to break out to the downside. When you get a breakout out of consolidation, typically it tells you the direction of the next move, or at a minimum, it helps us assess probabilities. Fractals impact financial markets, and fractals appear in nature as well. Practically every example observed involves what appears to be some element of randomness, perhaps due to the interactions of very many small parts of the process. From Yale, so it applies to the financial markets. How can we use that, and how can that help us? Fractals tell us that movements in the financial markets are nearly identical when viewed on a 1-minute scale, a 60-minute scale, a daily scale, a weekly scale, and a monthly scale. Said another way, if you took a group of charts and you removed the scales, I couldn't tell the difference or identify the time periods based on the movements because they look similar across all time frames. Therefore, the concept of consolidation and indecisiveness and a bullish or bearish breakout can be applied, and it applies to all time frames in the financial markets. It's important to note the consolidation doesn't tell us anything about the direction of the breakout. That's why we wait to see evidence, which applies to the current period of consolidation in 2015. One of the perplexing things about financial market history and the history of human beings, we all tend to make the same mistakes over and over again, and that's why we have bubbles in tulip bulbs, and then years later we have a bubble in dot-com stocks. Our tendency is, if we see a period of consolidation, we think it will continue. Therefore, we get tweets that say we're going to remain in this range for the rest of the year. That may be, it may not be. In the real world, when we see a warm day in February, we typically think the next day will be warm. How does that impact us in the financial markets? The next 15 years will most likely look like the last 15 years. The last 15 years, for the most part, have been up, down, up type of behavior, consolidation. Bonds have done extremely well since 1982. Interest rates have been in a 33-year downtrend favoring bonds. Therefore, recency bias tells us that many believe bonds will continue to perform well. Why? They've performed well in the past, and everyone should own them. That may or may not be true. We're human beings over here at Shivako Capital, and that's why we developed the CCM market model. The market model helps us reduce the probability of making the same mistakes over and over again. Now, we're going to take basic concepts and apply them to history and ask, how can that potentially help us in the future from a probability perspective? If you're experienced in the markets, this is basic stuff. You know this. Markets have a tendency really to do two things. They're in a trend, this is an uptrend, or they consolidate. Consolidation, this is an uptrend. We can obviously flip these charts, and we can have a downtrend as well. As we showed earlier, when we consolidate, we don't know which way we're going to break. It could be up or it could be down. How do these charts apply to 2015? Remember, recency bias may have us thinking that we're near a peak again, similar to the peaks in 2000 and 2007. We're back up here again. It makes sense that we'll peak again. But what do the charts say? Our bias may tell us that the next 15 years will look like a consolidation pattern, because that's what we've done in the last 15 years. History paints a different picture and tells us to keep an open mind about all outcomes. These charts are all 15-year periods in the S&P 500 index. 15 years of gains from 1950 to 1964. We all know the expression, the market needs to consolidate its gains, were followed by 15 years of consolidation in the S&P 500 between 1965 and 1979. We all know that a sideways pattern, the longer we go sideways, the bigger the move that we would typically expect when we break either up or down. That's our rectangle. 1979, after 15 years of sideways movement, did the next 15 years look similar? Did we go sideways again? No. Consolidation was followed by 15 years of gains, 1980 to 1994. The market needs to consolidate its gains. We hear that a lot, and it did. The next 15 years didn't look like this. Recency bias might have us say the markets are going up forever. The markets are going up forever. The bias, it didn't help. We went sideways. Here, we might say the markets are going to go sideways forever. Didn't help. They actually went up. And here, our recency bias tells us that in the last 17 years, we rallied for several years, then we peaked and had a crash. We rallied for several years, we peaked, and we had a crash. Therefore, we're going to rally for several years, and then we're going to peak, and we're going to have a crash. It should be noted, this is a bullish breakout that occurred in calendar year 2012. The S&P 500 broke above these levels. Fractals tell us that this is a consolidation period with a bullish breakout. And fractals tell us that if consolidation followed by a bullish breakout tells us the probability of good things happening has increased, the same concept applies to a much longer time frame. If you've been close to the markets over this period, I started on Wall Street in 1994, so this is what I've seen. You may have noticed since this point here, things have been different. Huge correction, volatility. And since this breakout, everybody has been waiting for the recency bias to return, and so far it has not. The market appears to have changed its tone. We have a bullish breakout here. That isn't up for debate. Fractals tell us we're well above 1600 here. We had consolidation, resistance, support in the same general area, resistance in the same general area. I can draw a rectangle around this. In 2015, we're well above 1600, and this breakout, the bullish breakout, is holding, telling us to keep an open mind about bullish outcomes. We're 15 years of consolidation followed by 15 more years of consolidation. No, we had a bullish breakout above this level here eventually, and stocks rallied for several years. The same concept may apply to the present day. Regular viewers and clients know this is not the first time that we've talked about fractals and bullish breakouts. We're looking at the broader NYSE Composite Stock Index going back to late 2005, early 2006. You can make an argument that this is some form of consolidation. Resistance, support in the range, bullish breakout after years of consolidation, a successful retest here, and as of Friday, June 11th at 1:53 p.m., we're holding above this level. So this chart tells us as long as this bullish breakout holds, it doesn't tell us anything about what's going to happen. It just tells us it makes sense to combat our human recency bias with a flexible, unbiased, and open mind. We don't need to know what's going to happen in advance, especially when we use the market model. But to implement using price or the market model properly, it is extremely important that we keep an open mind about all outcomes. It's easy to visualize bearish outcomes. There's numerous reasons to be concerned. These charts help us remain flexible and open-minded about better than expected bullish outcomes. It's not a stretch to take the consolidation period back even further. Support back in 2002, 2003, support in the same general area, resistance here, resistance here, resistance here in our bullish breakout. The same concepts apply to global stocks. Resistance, resistance, price rejected, resistance, price rejected, price rejected. Notice here, this is where the tone of the markets began to change in 2013. A bullish breakout that's held, then a bullish breakout above this level. It was retested here. Now we've broken above this level going all the way back to 2007. Years of consolidation followed by a bullish breakout, somewhat of a retest here, here, and here, and we're holding. So if Greece is going to implode the global financial markets, it's not being reflected in this chart as of Friday, June 11th. As always, we'll keep an open mind about all outcomes, including bearish outcomes. Anything is possible. Our concerns would increase significantly if this chart moves back into this area here. Have the bullish breakouts been broad from a global perspective? Yes, I know you can't read this. But what this basically tells you is the chart that we just looked at, the FTSE All-World Index, and its bullish breakout after years of consolidation includes countries from around the globe, makes up about 50% of it, and the United States of America makes up about 50% of it. So we have had broad participation in these long-term breakouts after years of consolidation. As clients and regular followers know, we're not in the prediction business here. We don't need to know what's going to happen in advance. Everything that we're saying here really won't impact anything that we will do, with the exception of helping us keep that flexible, unbiased, and open mind about all outcomes. Recency bias can also impact our thoughts on where bonds will go. Recency bias tells us that the next 17 years will look like the last 17 years. Bonds did extremely well relative to what you would expect in bonds. Why? One of the reasons is there was risk. Bonds attract capital when there's systemic risk here, the financial crisis. Bonds attract capital when fear is high after the dot-com bust. Bonds attract capital when we think Europe is on the ropes. So it's important for these reasons. Now we've broken out of this. If we stay above 1,600 on the S&P 500, we need to keep an open mind about the use of bonds as a defensive mechanism in the next 17 years. Also, recency bias in our lifetime, adult lifetime, 1981 2015, we talked about this a few weeks ago. The trend in interest rates has been down. Recency bias may have us saying everyone should have a fixed allocation to bonds in their portfolio because a fixed allocation to bonds worked well over the last 30 some odd years. It's possible that the next 30 some odd years will see this trend reverse, which aligns with the bullish breakouts on the stock charts. The stock charts are telling us that the perception of risk, downside risks, have improved, or else we would not have broken out to the upside. And that aligns with the possibility, no forecasting, of a reversal here. If that's true, numerous asset classes could be adversely impacted, and recency bias could tell us they'll do well, and in all actuality, their performance, if this reverses, could greatly disappoint. We can hammer the concepts home in terms of keeping an open mind if we review the charts that were included in this recent post. Remember, we said the S&P 500 consolidated, went nowhere for 26 years. Fractals tell us that this is a bullish breakout, and our expectation about what happened next should be bullish, and that's exactly what happened. Consolidation, bullish breakout, years of gains. In fact, 13 years of gains. Notice the breakout was held, in this case, never revisited. The Dow moved sideways and consolidated for 17 years here from 1965 to 1982. Fractals tell us that this is a bullish breakout, and our expectation in terms of what happened next should be bullish. 17 years of consolidation, a bullish breakout. After the breakout, this is the Dow here, we're using the S&P 500 in the same period. After the Dow broke out, we had 18 years of gains, telling us to keep an open mind about what will happen after the breakout that we had in 2013. There are a lot of things to be concerned about in 2015. You may be saying, no way. A healthy dose of skepticism is actually part of the historical profile. For example, here in 1979, Business Week published the now infamous cover, The Death of Equities. So in August of 1979, there was a very, very high degree of skepticism. If we would have told you in 1982, 1981, 1980, 1979 that the charts of the stock market would look like this over the next 18 years, you would have rationally said, no way, not going to happen. Are we expecting something like this to happen? No, we're not. We don't know what's going to happen. We're just saying the charts, as they sit today, and as long as the bullish breakouts hold, are just telling us to keep an open mind about all outcomes. As always, price will guide us. The longer you study charts and work in the financial markets, the more you respect the expression experience counts. This is a story that was recently told to Financial Sense by the godfather of technical analysis. The story is from 1970. A younger Ralph was talking to a widely accepted stock market and technical expert of the day in 1970, Ken Ward, who was 80 years old in 1970. Therefore, Mr. Ward had seen it all. Ralph asked him, Mr. Ward, what's the most difficult market that you've seen? And then he interrupted and said, wait a minute, obviously it's 1929. Nope, Mr. Ward responded, no, the most difficult market was the early 60s. And Ralph interrupted and said, but Mr. Ward, stocks went up in the 60s. The response from the 80-year-old, stocks sure did go up in 1960. We were all looking for a correction, and the market just kept going, climbing and climbing. Ralph finishes the story in 2015 with sound familiar. As we noted earlier, the market's tone has changed since the bullish breakout above 1600 on the S&P 500 in 2013. How long will that last? We have no idea. But as long as the breakouts that we're showing on these charts hold, price and history is telling us to keep an open mind about better than expected outcomes over the next 10 to 20 years. This is a May 30th, 2015 article in Barron's. It's another experienced voice, someone that has seen secular bull markets and secular bear markets. The Raymond James veteran chief investment strategist recently said he believes that the market could surprise on the upside and the S&P 500 could move to 4,300 within 9 years. So the charts and experience are saying keep an open mind about upside. This is a weekly chart of the S&P 500 index as of the close on Friday, June 12th, 2015. We're going to move through the rest of the video quickly. Why? If price is our guide, not much changed this week over the last 5 trading sessions, despite the bad news and surprising news out of Greece. The S&P 500 actually was green this week, was up 1.28 points. More importantly, here, this is that doji look that we've talked about before. There's your little cross. What this tells us is this was the high for the week. This is the low for the week. Price closed somewhere in the middle of the range near support and then rallied. Here, we have a decline. This is a doji look. The bears had an opportunity and a reason from a fundamental perspective to take this weekly chart into this area here. It may happen next week, but it hasn't happened yet. And this doji look tells us to keep an open mind about a bounce near support. Here, support, we're above it. This line here also held this doji in the past and here. So this area here seems important on the weekly chart as well. Now we're looking at the daily chart as of the close on Friday, June 12th. Our tweet from May 29th basically said, we will try to remain patient as long as the S&P 500 does not close below 2067, 2064, or 2039. The close, despite the weakness on Friday, was 2094. So we've stayed above all of these levels. Not much has changed except this low here is important now. That's 2072 and change. Why? The pink trend channel seems to be relevant. Resistance, 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 support, 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 support. So this now has been identified as being relevant again. There's a however coming. The green is still relevant. We don't want to throw it out. However, if we close in this area here, now we have a lower high. And if we close down here, we would have a lower low. And it's possible that the rules in the model and the math would have us take an incremental step away if we close in this area. This is still the most important number from a probabilistic perspective, and this green line in this area here around 2055 is still important. Notice the slope of the 50-day. It's positive. Notice the slope of the 200-day. It's positive. So as always, as we head into next week, we'll keep a flexible, unbiased, and open mind. Price will guide us if we're willing to listen. For now, we remain in the same range that we've been in. Price is not doing anything particularly new here. Updating regular viewers, these moving averages here are included in the market model, but by no means are they the market model. This is not the market model. We use this chart to illustrate concepts. The takeaway, this still looks a lot more like this bullish period in 2009 than any of these concerning periods in 2007. We do have a slowing momentum look here, but this isn't particularly concerning, especially considering price has not broken down yet. It's just telling us that if price breaks down, we should be prepared to potentially reduce risk. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.